Welcome to Griffonomics. Today we're diving into GoodRx, trading under the ticker GDRX. GoodRx is executing a structural turnaround, aggressively expanding into direct manufacturer commercialization and high lifetime value subscription memberships, while generating robust free cash flow and maintaining a $296.1 million cash cushion. However, this strategic transition creates a temporary drag, as deliberate shifts in product investment and retail pharmacy closures continue to contract its legacy prescription transaction volumes and compress historical consumer metrics.
Yeah, and I mean, if you're listening to that exact statement and thinking it sounds like this dense block of Wall Street jargon, let's bring it back down to reality for a second.
Right, please do.
Imagine holding a prescription for like a life-changing weight loss drug. You walk up to your local pharmacy counter, you hand over the slip, and the pharmacist just looks at you with a wince.
Well, the classic pharmacy win.
Exactly, and they tell you it's going to cost you $1,200 out of pocket today because, well, your health insurance absolutely refuses to cover it.
And you just feel your stomach drop.
Right. Totally. But now imagine looking at an app on your phone while you're literally still standing in that line and realizing you can buy that exact same drug directly from the manufacturer for $149.
Which is just a massive, jarring gap between those two realities. And really, that gap is what we are exploring today. Our mission for this deep dive is to look past a stock that has, plunged roughly 90% from its post-IPO highs.
It's been a brutal chart to look at.
Oh, absolutely brutal. So we are sifting through their Q2 2026 earnings reports, their investor presentations, and product press releases to figure out if Wall Street is just completely mispricing a massive corporate metamorphosis.
And it is arguably one of the most fascinating business transformations happening in plain sight right now. Because, I mean, if you only look at the headline numbers, GoodRx looks like a company that is slowly bleeding out.
Right.
But if you actually lift the hood and look at the plumbing they are building underneath the traditional healthcare system, they are constructing an entirely new engine. And this matters to you, the listener, in a very tangible way.
Because it hits the wallet.
Exactly. I mean, if you are an investor looking for an asymmetric value play, meaning a stock where the potential upside wildly outpaces the downside risk, this is a textbook case study in market mispricing. But honestly, even if you don't own a single stock, you are a consumer trying to survive in a fractured, incredibly opaque, and frankly, increasingly expensive healthcare system.
Yeah, we all have to deal with the pharmacy eventually.
We do. So understanding the mechanics of how this drug pricing arbitrage works will directly impact your wallet.
Okay, let's unpack this. Because we have to start by dissecting the mechanical variables behind their second quarter of 2026 performance. The surface level numbers are they're confusing.
Yeah, they are a bit of a paradox.
Totally. On one hand, you have total revenue coming in at $200.4 million for the quarter, and you look at their profitability, and Adjusted EBITDA reached $63.7 million.
Which is huge.
It is. And, for anyone who isn't staring at financial statements all day, Adjusted EBITDA is basically just a way to measure a company's core operating cash profit by stripping out taxes, debt interest, and non-cash accounting quirks.
Right. It's the actual cash engine.
Exactly. So hitting almost $64 million there translates to a 31.8% margin. I mean, keeping nearly 32 cents of operating profit on every dollar that comes through the door is phenomenal. So if the margins are that good, why has the stock been punished so severely over the last few years?
Because Wall Street hates complexity, right? And they especially hate shrinking core businesses, regardless of how good the profit margins are.
Yeah, the market wants simple growth narratives.
Exactly. To understand GoodRx today, you really have to split the company into two completely different entities. You have the old GoodRx and the new GoodRx.
Okay, lay them out for us.
So the old business is what they call prescription transactions revenue, or PTR. This is the classic legacy GoodRx that most people actually know. It's the free digital discount coupon you pull up on your phone and show to the pharmacist to get $10 off your generic blood pressure medication.
And that legacy business is cratering right now. The Q2 numbers show that PTR collapsed 26% year over year, dropping down to $106.4 million.
Which is a massive hit.
It is. A 26% drop in your foundational revenue stream is usually the kind of metric that sends institutional investors running for the exits screaming that the sky is falling.
It absolutely is. But you have to look at what is happening on the other side of the ledger. While the old coupon business is shrinking by 26%, their new growth engines are quite literally screaming higher.
The new GoodRx.
Right. Their Pharma Direct segment, which we are going to get into, deeply surged 76% year over year to $61.6 million. And at the exact same time, their subscription revenue grew 39% to reach $28.5 million. So you have this bizarre dynamic where the legacy business is shrinking, but is being offset by two newly incubated segments that are growing at speeds you typically only see in, like, early-stage Silicon Valley venture capital pitches.
I want to hold on that 26% drop in the legacy business, though, because I'm not entirely buying the whole "don't worry, it's fine" narrative just yet. Why is the core shrinking so fast? I mean, is the fundamental coupon model just broken, or did people suddenly stop needing cheap generic drugs?
No, it's neither of those things. It's actually a combination of severe macroeconomic friction in the retail space and a highly deliberate strategic choice by GoodRx management.
Okay, let's start with the macro side.
So GoodRx's legacy business was entirely built on physical foot traffic. It relied on a consumer walking into a brick-and-mortar retail pharmacy, standing at a physical counter, and presenting a code. But the physical retail pharmacy landscape in America is undergoing a massive, very painful contraction right now.
Right, because of all the closures.
Exactly. You have Rite Aid going through its Chapter 11 bankruptcy restructuring, closing hundreds of stores. And on top of that, you have CVS and Walgreens executing thousands of planned store closures nationwide just to cut costs.
So if the CVS on my corner closes down, my habit is broken. I have to find a new pharmacy, transfer my scripts, and in all that chaos, I might just forget to pull up the GoodRx app. Or maybe I just switch to Amazon Pharmacy and GoodRx loses my transaction entirely.
That is precisely the friction. Management actually estimates that the Rite Aid bankruptcy and the footprint reductions from CVS and Walgreens caused a massive $35 million to $40 million drag on their 2025 PTR revenue alone.
That's a huge chunk of change.
It really is. When a physical pharmacy closes, it's not a seamless transition for the patient. GoodRx's internal data shows they only recapture about 20% to 40% of those historical prescriptions at a new location.
So the rest just vanish.
Basically, yeah. To get the rest of those users back, GoodRx has to spend aggressive marketing dollars to retarget them and remind them to use the app at their new pharmacy.
But you also said this drop was a deliberate choice by management. That's the part that feels a bit like corporate spin to me. How is losing a quarter of your core business a deliberate choice?
I know it sounds like spin, but if you actually look at their capital allocation, the math backs it up. GoodRx is intentionally reallocating its marketing spend away from the old business. Think about what it takes to acquire a user who just wants a free coupon for a one-time antibiotic script.
A lot of ad spend, I'm guessing.
Exactly. You have to spend money on Google ads, television commercials, social media just to get them to download the app. They use the coupon once, GoodRx makes maybe $2 on the transaction, and then that user deletes the app or forgets about it until next year.
So it's high churn.
It is a high-churn, low-margin, incredibly volatile business model. Management, specifically CEO Wendy Barnes, looked at this and basically said, why are we pouring marketing capital into a leaky bucket?
Okay, that brings a specific analogy to mind. This feels like a massive retail department store that has this huge, messy clearance aisle right in the front.
Oh, I like where this is going.
Right, so the clearance aisle generates a ton of foot traffic, but the profit margins are paper thin, and the shoppers only come in when there's a steep discount. So management decides to intentionally shrink that clearance aisle by 25%, knowing full well it will temporarily tank their overall foot traffic numbers. Also, they can use that floor space to build a high-end, high-margin, subscription-only VIP lounge in the back.
Yes, that is perfect.
And Wall Street is just standing outside looking at the total foot traffic numbers plummeting and punishing GoodRx for the dust caused by the remodeling.
That is a phenomenal way to visualize it. They are trading high-churn, low-margin transactions for predictable, recurring revenue. It is the holy grail of business model transitions, moving from a transactional model to a SaaS-like software-as-a-service model.
But Wall Street just sees the dust.
Wall Street hates the dust, but for long-term durability, it's absolutely essential. Let's transition then, because to understand why they are so willing to let that legacy coupon business shrink, we have to deeply examine what they're building in that VIP lounge. Specifically, we need to dissect that explosive 76% growth in Pharma Direct. What exactly is this segment?
So Pharma Direct is where GoodRx stops being a simple discount app and starts becoming a fundamental commercialization layer for the pharmaceutical industry itself.
Okay, that sounds intense.
It is. This segment now accounts for 31% of total corporate revenue, and it is entirely different from the generic coupons. Pharma Direct is where GoodRx partners directly with the drug manufacturers to sell high-cost, brand-name drugs. And they aren't just dabbling here either.
They have real scale.
Oh, yeah. They have over 135 direct brand programs running right now, featuring absolute blockbuster medications. We're talking about massive drugs like Jardiance for diabetes, Nurtec for migraines, Otezla for psoriasis, and Rapaflo. And the absolute crown jewel of this direct-to-consumer segment, the thing driving this 76% revenue surge, has to be the GLP-1 weight loss drugs. I mean, this is the cash engine everyone in healthcare is talking about right now.
It is the defining pharmaceutical and cultural trend of the decade, without a doubt. GLP-1s have shifted from being strictly diabetes management tools to massive lifestyle obesity treatments. And GoodRx has quietly positioned itself as the primary toll booth for this entire cultural phenomenon.
A toll booth?
Yes, because they have secured day-one cash access prices that entirely bypass traditional insurance.
Let's put some hard numbers to that, because the cash prices we were looking at in the Q2 reports are just eye-opening. We were talking about Eli Lilly's oral Foundayo starting at just $149 per month on GoodRx.
Which is incredibly cheap for that class.
Right. And their injectable Zepbound KwikPen is starting at $299 per month. Over on the Novo Nordisk side, you have the high-dose Wegovy HD at $399 per month, and the highly anticipated oral Ozempic pill starting at $149 per month.
It's wild to see those numbers.
For anyone who has tried to get these drugs, you know that the standard list prices are often upwards of $1,000 a month. So how is GoodRx getting them down to $149?
Well, this requires us to look at a mechanism called the gross-to-net formulary bypass.
Okay, break that down for us.
To understand why this is revolutionary, you have to understand how broken the standard pharmacy system is. Usually, a drug manufacturer sets a high gross list price for a drug, say, $1,000.
Right.
But the patient's employer-sponsored health insurance doesn't actually pay that. The insurance company hires a middleman, known as a pharmacy benefit manager, or PBM.
The dreaded PBMs.
Exactly. The PBM goes to the drug maker and says, if you want us to put your drug on our approved list, our formulary, you have to pay us a massive secret rebate. So the drug maker pays a $600 rebate to the PBM just for access to the patient.
Wow.
Right, so the drug maker only nets $400. That's the gross to net bubble.
I see where this is going. But with GLP-1 specifically, the PBMs and the commercial health plans are just flat out refusing to cover them for weight loss, right? Because they view obesity treatment as a lifestyle choice, and they just don't want to foot a $10,000 a year bill for every single employee who wants to lose 20 pounds.
That is exactly it. Commercial health plans currently exclude about 1 in 5 brand name drugs from their covered formularies, and GLP-1s are at the very top of that exclusion list. So put yourself in the shoes of Eli Lilly or Novo Nordisk.
Okay, I'm the manufacturer.
You have spent billions researching and developing a miracle weight loss drug. You have unprecedented consumer demand. People are begging for it. But you have this massive wall of insurance denials blocking the actual sale. The traditional PBM system is failing you.
So the manufacturer says, forget the PBM, forget the rebate. If they won't cover it anyway, why don't we just bypass the insurance system entirely?
Yes. The drug makers realize that if they cut out the massive PBM rebate, they can actually afford to drop the cash price of the drug down to $149 or $299.
Which is a price point that an average self-paying consumer can actually afford out of pocket.
Exactly. They keep the same net profit they would have made anyway, but they unlock massive volume by going direct to the consumer.
But to go direct to the consumer, you need an audience. I mean, you can have a $149 price point, but if nobody knows about it, you don't sell any pills.
And that is exactly where GoodRx steps in. GoodRx controls 280 million annual visits to their platform.
280 million. That is just a staggering number.
They have the audience. But what's crucial here isn't just the sheer volume of traffic, it's the intent of that traffic.
What do you mean by intent?
Well, 85% of the people who visit GoodRx arrive with a prescription already in their hand. They aren't just browsing the internet, reading WebMD articles about potential side effects, you know. They have just left the doctor's office, they have a script for Zepbound, their insurance just denied it, and they are actively looking for a way to afford it right now.
They are at the very bottom of the marketing funnel. They have their credit card out, and they are ready to transact.
Yes. And because of that incredibly high intent, Drug makers are seeing a staggering 8x to 18x return on investment when they run these direct pricing programs on GoodRx.
18x ROI. That is unheard of.
It is. Compare that to when a drug company runs a TV commercial or buys Google ads for their own standalone brand website. It's vastly more efficient for pharma to just pay GoodRx to place the cash price in front of an audience that is already holding the script.
Okay, here's where it gets really interesting, though. I'm going to push back on this competitive mode a bit.
Sure, go for it.
If 85% of the users already have a prescription in hand when they open the app, GoodRx isn't actually creating the demand for the drug, right? The doctor and the drug manufacturer created the demand. GoodRx is just acting as a toll booth on the highway between the clinic and the pharmacy.
Right.
So if a pharmaceutical giant like Eli Lilly realizes they are paying GoodRx millions of dollars a year in marketing fees for this toll booth, what stops us from just building their own? Why not just launch LillyDirect.com, offer the $149 price there, and cut GoodRx out entirely?
What's fascinating here is that the manufacturers have tried exactly that. I mean, almost every major pharmaceutical company has launched their own direct-to-consumer portals with savings cards.
And did it work?
No. What they quickly learned is a fundamental law of consumer behavior. Aggregation always wins over fragmentation.
You're talking about the Amazon effect.
Exactly. If you need to buy running shoes, batteries, and a new blender, you don't go to the Nike website, then the Duracell website, and then the KitchenAid website.
You just go to Amazon.
You go to Amazon because everything is aggregated in one search bar. Healthcare consumers are no different. A patient might be on a generic statin for their heart, a branded inhaler for asthma, and a GLP-1 for weight loss.
Right. They aren't going to juggle a dozen apps.
They absolutely refuse to download 15 different pharmaceutical apps or memorize 15 different brand websites just to check prices. GoodRx has become the definitive aggregated search engine for drug affordability.
So they have to be there.
Exactly. Even if a drug brand operates its own website, they are basically forced to list their cash prices on GoodRx because that is where the 280 million aggregated eyeballs are.
That makes total sense. The moat isn't the technology. The moat is the aggregated consumer habit. But here's the challenge, right? Bringing a patient in for a 149 GLP-1 cash fill is a great one-off win for the Pharma Direct segment. But getting them to stay in the GoodRx ecosystem permanently for all their other medications so they don't leak back out to a traditional pharmacy.
Right, that's the hard part.
That is the real holy grail of this turnaround. Which brings us to Section 3, the subscription transformation and companion economics.
And this is where we see management aggressively pushing that transition from a transactional coupon company into a recurring revenue machine. In May of 2026, they officially launched their new premium tier called GoodRx Companion.
Let's break down the unit economics of Companion because they are actively migrating users to it, and they already boast 764,000 active subscription plans, which is up 14% year over year.
It's gaining serious traction.
It is. The Companion plan costs $14.99 per month, or if the consumer commits to an annual plan, it drops to $9.99 a month. And for that entry fee, members get an incredible bundle. They get up to 200 different generic medications completely for free.
Which is wild.
They get hundreds of other generic drugs for under $10. And they get access to virtual care telehealth visits for just $19.
And understanding that specific bundle is the absolute key to reconciling a metric that has been terrifying Wall Street analysts over the last few quarters.
You mean the user drop?
Yes. If you look at the Q2 earnings print, GoodRx's legacy monthly active consumers, their MACs dropped to just 5.0 million. For context, that number used to be significantly higher, peaking well above 6 million.
And when Wall Street analysts see a tech-enabled platform losing active users at that scale, they just assume the business is dying.
Exactly. But management, specifically CEO Wendy Barnes and incoming CFO Justin Fengler, they are practically shouting from the rooftops that this is intentional. They explicitly view this contraction as a value accretive shift.
Because they're aggressively filtering their audience.
Right, exactly. They are letting the low-margin, high-churn coupon users fall away, and they are converting the stickiest, most valuable users into these high lifetime value companion memberships.
Think about your own habits for a second, you listening to this right now. Put yourself in the shoes of someone managing high blood pressure, cholesterol, and maybe like a thyroid issue. Would you rather hunt for 3 different digital discount codes every 30 days, staring at your phone in the CVS line, praying the pharmacist accepts them without a hassle, while the people behind you roll their eyes?
Nobody wants to do that.
Right. Or would you rather just pay 15 bucks a month, walk up to the counter, and have all your generic drugs ring up as $0 forever? The psychological convenience factor is massive, but I have to stop and do the math here because it sounds a little too good to be true for the consumer.
Math is important.
If GoodRx is giving away 200 generics for free, aren't they just eating the cost of those drugs? How does a company stay in business paying for their customers' medication?
It looks like they are losing money on the surface, I'll give you that. But it's actually a master class in a loss leader bundling strategy. You have to understand that generic drugs, at their actual wholesale manufacturing cost, are incredibly cheap.
Like how cheap?
We are often talking about pennies per pill. The $20 or $30 markup you see at the retail pharmacy counter isn't the cost of the drug. It's the administrative bloat of the pharmacy, the PBM fees, and the distribution markups.
So GoodRx is just absorbing that underlying ultra-cheap wholesale cost for those 200 generic medications.
Correct. Let's say it costs GoodRx $2 a month in actual wholesale drug costs to supply a patient's generic prescriptions. In exchange for eating that $2 cost, GoodRx captures nearly $180 a year in predictable, high-margin subscription revenue from that user.
Wow. Okay, the math definitely works.
But more importantly, they lock that user firmly into the GoodRx digital ecosystem.
I see the loop. If a patient is getting all their daily generics for free through the Companion app, they are opening that app constantly. It becomes their default healthcare interface.
Exactly.
So 6 months later, when that same patient visits their doctor and gets a prescription for a high-cost, brand-name GLP-1 weight loss drug, where do they go to check the price?
They go right back to the GoodRx app they already pay for. And boom, that feeds the consumer right back into the highly profitable Pharma Direct segment we just talked about, where GoodRx collects a massive bounty from the pharmaceutical manufacturer. It creates this perfect closed-loop ecosystem.
Okay, so they have the direct pharma pipeline set up to capture the high-end brand drugs, and they have the consumer subscription net to catch all the generic volume underneath it. It's a brilliant trap for consumer demand.
It really is.
But healthcare is a multi-sided market.
Yeah.
You can build the most elegant consumer app in the world, but if you don't get the doctors and the employers on board upstream, the whole funnel just dries up.
Which is exactly why Section 4 of our analysis is so critical. We have to look at the B2B business-to-business network effects that GoodRx is deploying to protect this moat.
They aren't just waiting around for patients to open the app anymore.
No, not at all. They have executed 3 vital upstream integrations to intercept the transaction before the patient even knows they need a drug. These are Surescripts, direct contracting, and employer direct.
Let's start with Surescripts, because this blew my mind when I read their earnings report. Surescripts is the massive, invisible digital plumbing of the American healthcare system. They process something like 2.6 billion electronic prescriptions a year.
It's basically the backbone of prescribing.
Right. Whenever a doctor types a prescription into their computer instead of writing it on a paper pad, it routes through Surescripts. And GoodRx just partnered with them to launch something called Script Corner.
Yeah, and if we connect this to the bigger picture, Script Corner is the ultimate point-of-care marketing weapon. GoodRx has integrated their pricing API directly into that Surescripts plumbing.
So how does that look in practice?
Imagine the workflow. A doctor is sitting in the exam room with a patient. The doctor types a prescription for a generic statin into their electronic health record software. At that exact millisecond, Surescripts pings GoodRx. Automatically, GoodRx checks the patient's insured price versus the GoodRx cash price. If GoodRx is cheaper, it triggers an automated text message directly to the patient's phone before they even walk out of the clinic doors.
That is wild. You are acquiring the customer before they have time to even think about going to the pharmacy. It completely bypasses the confusion at the pharmacy counter. By the time the patient drives to Walgreens, they have a text message showing them exactly what the drug costs and a button to click to use the GoodRx code.
Exactly. It removes all the friction. But getting the patient to the pharmacy is only half the battle. You have to make sure the pharmacy is actually willing to accept the GoodRx discount when the patient arrives.
And historically, that has been a very contentious relationship, which brings us to their second integration, direct contracting.
Right. We talked earlier about how retail pharmacies are struggling and closing stores. Historically, pharmacies hated discount apps because the apps routed the transactions through the PBM middlemen.
And the PBMs would scrape off a huge fee.
Right. They would squeeze the pharmacy's profit margin to the bone. Often, a pharmacy would actually lose money filling a GoodRx coupon script. But GoodRx is changing the plumbing here, too. They now hold direct, paper-direct contracts with 9 of the top 10 retail pharmacy chains across 70,000 locations nationwide.
So by contracting directly with the physical pharmacies, GoodRx cuts the PBM middleman entirely out of the transaction flow.
Exactly.
This does something vital. It restores dispensing profitability to the struggling pharmacies.
Yeah.
If GoodRx can guarantee the pharmacy a fair margin on the drug, the pharmacy stops viewing GoodRx as a parasite eating their profits and starts viewing them as a crucial partner driving guaranteed volume to their counter.
It aligns the incentives beautifully. And the third piece of this upstream puzzle is the enterprise expansion through what they call Employer Direct. They recently highlighted launch partners like the massive Midwestern grocer Hy-Vee.
Explain how this works, because this feels like GoodRx invading the commercial insurance space directly.
They absolutely are. Large companies like Hy-Vee are usually self-insured, meaning they pay their employees' medical claims out of their own corporate treasury. They just hire a PBM to administer the paperwork.
Right, they hold the actual risk.
Yes. And these employers are incredibly frustrated right now. Their employees are demanding coverage for GLP-1 weight loss drugs, but the PBMs are either denying coverage entirely or charging the employer astronomical rates.
So what does GoodRx do?
GoodRx is stepping into that boardroom and saying, don't use your PBM for this. Use the GoodRx Enterprise platform. You can directly subsidize the cash prices for these GLP-1s and buy your employees' GoodRx Companion plans using funds from their wellness accounts.
So what does this all mean? If you step back and look at these three integrations, GoodRx is systematically flanking the entire traditional insurance industry.
They're surrounding them.
They are intercepting the prescription at the doctor's office via Surescripts. They are funding the transaction through your employer via Employer Direct. And they are fulfilling the transaction at a guaranteed profit for the pharmacy through direct contracting. It is a total end-to-end bypass of the PBM system.
This raises an important question, though. Will the massive multi-billion-dollar traditional PBMs just sit idly by while GoodRx eats their lunch? I mean, you are essentially building a parallel cash-pay healthcare system right next to them.
Right. Why wouldn't a giant like CVS Caremark or Express Scripts just crush them or use their leverage to cut GoodRx off from the pharmacy networks entirely?
It's a great question, and management's stance on this is honestly a masterclass in diplomacy. Wendy Barnes argues that GoodRx is not actually disrupting the PBMs. She claims they are a non-disruptive complement.
A compliment.
Yeah. Her logic is that employers are primarily using GoodRx Employer Direct for the drugs that the PBMs have already explicitly excluded from their formularies, like the GLP-1s.
Oh, I see.
The PBMs didn't want to pay for the obesity drugs anyway. So GoodRx isn't stealing covered volume. They are just swooping in to service the uncovered, rejected demand. It relieves the political pressure on the employer without actively antagonizing the PBM's core covered business.
It's an incredibly elegant needle to thread. We aren't fighting you. We're just cleaning up the mess you left behind.
Perfectly put.
And this upstream integration couldn't be happening at a better time, because as we move into Section 5 of our deep dive, there are massive macroeconomic and political forces actively pushing more and more Americans into this exact cash pay market that GoodRx dominates.
That's right. The macro policy tailwinds are blowing fiercely in GoodRx's direction right now, regardless of the broader economic climate.
Let's look at the systemic numbers.
Okay.
Over the last year, we've seen the loss of roughly 3 million Affordable Care Act, or ACA, marketplace enrollees, largely due to the expiration of enhanced federal subsidies.
Right.
And on top of that, we are seeing legislated Medicaid tightening at the state level under the newly enacted One Big Beautiful Bill Act, or OBBBA. Now, I want to be crystal clear to you listening. We are not here to endorse or critique the politics of these policies.
Absolutely not. We are strictly looking at the numbers.
Exactly. We are purely analyzing market dynamics and the shifting patient pools. But mathematically, when millions of people lose subsidized government health coverage, they don't magically stop having diabetes or high blood pressure or migraines. They still need their medications.
Exactly. The need doesn't disappear. The funding source just changes. Those millions of people transition overnight from being fully insured patients with a standard copay to cash pay patients desperately looking for discounts just to survive.
Which plays right into GoodRx's hands.
It does. That legislative shift artificially expands the total addressable market for GoodRx. When the traditional insurance safety nets pull back, GoodRx's discount platform essentially becomes the de facto safety net for the American public.
And speaking of the government, we have to talk about TrumpRx.gov. Initially, when a federal direct-to-consumer medication pricing portal was announced in the headlines, there was a lot of market panic.
Oh, yeah, investors were terrified.
Right. They looked at that and thought, well, if the federal government is launching a free website offering transparent drug prices, doesn't that instantly kill GoodRx's business model?
It's a totally logical fear, but the reality under the hood is the exact opposite. GoodRx is actually a core backend launch partner for TrumpRx.gov.
Wait, really?
Yes. Far from being disrupted by government tech, GoodRx's proprietary software infrastructure is actively powering the cash pricing engine for over 30 Pfizer brand medications and over 600 generic drugs directly on the federal site. They are the engine inside the government's vehicle.
Which just proves how incredibly deep and complex their technological moat actually is. The government realized that building a real-time, nationwide drug pricing engine from scratch is nearly impossible, so they just plugged into GoodRx's existing API.
It's brilliant. GoodRx gets the volume, the government gets the headlines, everybody wins.
So with all these tailwinds, the government partnerships, the GLP-1 boom, the subscription growth, let's pull back and look at the cash flow forensics. Because if a company is pivoting this hard and letting their legacy revenues shrink by 26%, they need a fortress balance sheet to survive the valley.
And their balance sheet is remarkably robust for a company whose stock chart has looked so grim over the last 2 years. They are currently sitting on a $296.1 million cash cushion.
That's solid.
And more importantly, in Q2 alone, they generated $80.8 million in actual operating cash flow.
But let me push back on that because you're painting a very rosy picture and I'm staring at a rather ugly line item here. They have $492.5 million in gross term debt maturing in 2029.
Right, the debt wall.
Look, almost $500 million in debt coming due in just a few years sounds terrifying for a company whose foundational core business is actively shrinking. If I'm an investor, shouldn't I be sweating that debt wall? What happens if the GLP-1 craze cools off?
It's a totally fair concern, but if we connect this to the bigger picture of cash generation, the fear subsides a bit. Remember that $80.8 million in operating cash flow was generated in one single quarter.
Right.
Even if their business completely flatlines and doesn't grow another inch, they are generating over $320 million a year in pure operating cash. That mathematical reality proves the company can easily self-fund its transition, heavily invest in marketing for Pharma Direct, and still comfortably service, pay down, or refinance that 2029 debt wall without diluting shareholders. The balance sheet is not a liability here, it is a shock absorber.
And management is clearly confident in that shock absorber because they actually upgraded their full year 2026 guidance. They raised their total revenue target to a range of $790 million to $805 million, and they bumped their adjusted EBITDA guidance up to between $240 million and $250 million.
Which is a very strong signal.
And according to the earnings call, that confidence is heavily supported by the fact that they now expect the Pharma Direct segment to grow by more than 70% for the full year.
Which brings us to the ultimate question we set out to answer today.
Right. We've reached Section 6, the final verdict and execution risks. We've looked at the underlying mechanics of the turnaround. We've seen the absolute gold mine that GLP-1 cash access represents.
We've unpacked the unit economics of the companion subscriptions.
The genius of the Surescripts point-of-care integrations, and we've audited the cash flow positive balance sheet. It is time to bring it all together and ask the million-dollar question. Is this stock actually a buy?
Let's synthesize the investment case. If you look at their enterprise value based on current trading prices, GoodRx is trading at approximately 5.6 times their 2026 expected Adjusted EBITDA.
5.6 times, let that sink in. For a tech-enabled healthcare platform that is actively growing its two newest most important segments at 39% and 76% respectively, that is a dirt cheap, almost distressed multiple.
It is remarkably cheap, and it exists solely because the broader market is pricing GoodRx as if it is still just a legacy one-off coupon app suffering a slow, agonizing death by 1,000 retail pharmacy closures.
Right, they are just looking at the top-line contraction.
The market's algorithms are looking at the dropping monthly active consumer numbers and the shrinking legacy revenue, and they are completely ignoring the massive SaaS subscription engine and the enterprise Pharma Direct commercialization engine that are actively taking over the revenue mix.
Let's go back to our summary analogy to really cement this. GoodRx is no longer just a coupon app for the clearance aisle. It has evolved into the indispensable digital pricing bridge connecting consumers, drug makers, and pharmacies across an increasingly fractured and hostile healthcare system.
Right.
At a 5.66 EBITDA multiple, Wall Street is pricing this toll bridge as if it's made of rotting wood and about to collapse, completely ignoring the fact that management is actively rebuilding it with steel and routing the most profitable traffic in the pharmaceutical industry across it.
That is the definitive bull case, and it is a strong one. But as analysts, we cannot just cheerlead a turnaround. We have to temper that excitement by strictly outlining the execution risks, because no corporate pivot is ever guaranteed.
Obviously not.
Based on the data, there are three primary risks that could derail this thesis.
Let's go through them. What is risk number one?
The first is persistent contraction. We know the legacy prescription transaction business is shrinking due to those Rite Aid and CVS closures. The risk here is a timeline mismatch. What if the retail pharmacy friction drags down the top-line revenue much faster than Pharma Direct and subscriptions can scale up to replace it?
So they run out of runway.
Exactly. If the old business bleeds out too quickly, the cash flow could evaporate before the new business achieves critical mass.
It's a race against time. The VIP lounge has to open before the clearance aisle goes entirely bankrupt. Okay, what is the second risk?
Concentration risk. We discussed how an enormous portion of that spectacular 76% growth in Pharma Direct relies heavily on self-pay GLP-1 adoption. The entire thesis requires consumers to keep willingly paying $149 to $399 out of pocket for obesity drugs.
Right.
But what happens if the insurance landscape shifts? What if Medicare or major commercial health plans suddenly decide, actually, it's cheaper for us to cover weight loss drugs universally than to pay for the heart surgeries and diabetes treatments that result from obesity? If insurance expands formularies to include GLP-1s, the cash pay thesis weakens significantly.
I have to interject there because that feels like an existential threat. If the insurance wall falls and my employer covers Zepbound for a $10 copay, the GoodRx bypass isn't needed anymore. I don't need a $299 cash price if my insurance will do it for $10.
Exactly.
GoodRx's monopoly on this traffic could vanish overnight if the PBMs change their tune. That is a massive risk. And the third?
The third is KPI opacity, key performance indicator opacity. Investor skepticism is incredibly high right now because management is retiring their historical North Star metric, the monthly active consumer, or MA.
Which people hate.
Right. Now, management argues that MAC doesn't accurately reflect the new reality of high-value subscriptions and direct pharma programs, which is entirely fair, but they are removing it without immediately offering Wall Street a clear one-to-one replacement metric for tracking total prescription fill volumes.
Yeah, saying, we'll give you a new metric in 2027 doesn't exactly inspire confidence when you are a portfolio manager trying to justify holding the stock today. When management takes away a familiar key performance indicator and replaces it with a black box, Wall Street's default assumption is always that the company is trying to hide bad news.
Always.
So to you listening right now, you have to weigh these realities. What stands out to you is a 5.6x multiple generational steal for a company that has successfully secured the cash pay monopoly on the biggest drug class in history. Or is the lack of transparent KPIs and the reliance on GLP-1 cash pay a massive red flag warning you to stay away?
It perfectly encapsulates the classic tension of a turnaround stock. The underlying financial numbers and the strategic partnerships suggest the structural shift is working beautifully, but the broader market demands undeniable, transparent proof before it will assign a premium valuation to the stock again.
We've covered an immense amount of ground today. We watched GoodRx evolve from a vulnerable, shrinking coupon business overly reliant on physical foot traffic and threatened by Rite Aid bankruptcies. We explored how they are transforming into a thriving Pharma Direct and subscription machine powered by blockbuster GLP-1s.
We really went into the weeds.
We did. We broke down how they are aggressively intercepting prescriptions right at the doctor's office via Surescripts,
Right.
how they are contracting directly to save struggling pharmacies, and how they're even providing the software backbone for the federal government's pricing portals.
They are systematically positioning themselves not just as a consumer app, but as the essential, inescapable commercialization layer of the modern pharmaceutical industry.
I want to leave you with one final provocative thought to mull over as you go about your week. If GoodRx now controls 280 million highly intent healthcare visits a year, and they have the direct relationships with the drug manufacturers, and they are already routing telehealth visits for just $19 through their companion subscription, what is actually stopping them from bypassing the traditional pharmacy and insurance system entirely?
It's a great question.
What stops them from taking all this infrastructure and becoming a massive, vertically integrated digital hospital of their own? Thank you for joining this deep dive. Stay curious, keep questioning the consensus, and always keep looking past the headlines.